Hello, 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 everybody. It's your boy, Chicago Sean McLaughlin. How are you? Welcome back. It's spring. It's warm and sunny outside my window. I'm itching to get back outside. Spent a lot of time outside this weekend, which was great. Sorry, I'm a little late on these videos. I usually do these Sunday night, but the day got away from me yesterday. Anyway, I'm going to keep this video short. I didn't have a whole lot of questions to go over this week, but I did have one somebody was asking me about. They wanted to know about portfolio construction. They wanted to know, what's the ideal mix of trades to have in a portfolio? Should I only have 3 trades on? Should I have 10 trades on? Should I have 100 trades on? And the short answer is, there's no one right answer for you. It kind of depends on how big your positions are, how comfortable you are with risk, how diversified your positions are. A good rule of thumb that I like to go by is I don't care about the total number of trades that I have on. I'm more concerned about how much risk I am exposed to in total. So in a worst case scenario where all my positions go to 0, what's that going to cost me? What's that impact going to be to my account? I think a good rule of thumb, if you have a portfolio that's strictly focused on options trading, I think having no more than 10% of your portfolio at risk is probably a good starting point. You might be able to push 20% depending on how comfortable you are. But once you start getting beyond 20%, you put yourself in a situation where if you're holding a lot of positions, maybe they're all long or maybe they're all short, and if a broad market reversal happens, you could be exposed to a pretty significant pullback. And I don't know about you, but if I were to lose more than 20% of my account in any one day or in a short period of time, that's hard for me to stomach. That's something I don't like to do. It happens to me from time to time, but I don't like that feeling because a 20% drawdown is hard to come back from quickly. All right. So a good rule of thumb is, let's say you're putting all your trades on all defined risk trades. Maybe they're long calls, maybe they're call spreads, maybe they're calendar spreads. Regardless, you know what your risk is on a per position basis. So you know that you're risking $500 per trade or $300 per trade, whatever the number is, doesn't matter. Well, if you're willing to risk, if you have a $100,000 account and you're only willing to risk $10,000 of your account, which is 10% of the account, I would want all my trades to maybe not be risking more than $500 per trade and have 20 of those trades on, right? I mean, that's going to be $10,000 right there. Did I do that math right? Yeah. So whatever that math is, just make it work out so that the worst case scenario, if you lose all your money on all those trades, if they all go to 0, it'll suck and it'll hurt, but you could come back from that, okay? The name of this game is longevity. You have to stay in the game. I've been in this game for 23 years. I'm succeeding by existing, right? And the only way you get experience in this game is by having your ass in the seat and putting in the work and putting in the time. And the only way you can put in the time and get that experience is by not doing stupid things to lose all your capital, all right? So keep your return streams as docile as possible. So that's my thought for you this week. I hope that was instructive. I hope that gave you some food for thought. If you have any comments or questions, throw them into the YouTube chat or hit me on Twitter at Chicago Sean. I'm always happy to answer questions. Trade them well, everybody. Have a great week. I'll talk to you soon.